Well, good afternoon, and welcome to another in our series of our Wednesday webinar series. I'm Kelly Bearden. I'm the director of the CSU Bakersfield Small Business Development Center, and we're live from the campus of CSU Bakersfield. And we're presenting webinar volume number 53 in our series that have been going on since 2013. And we got another great topic for you today on small business microlending. So we have a distinguished panel that I will get into in just a second, and a little bit about the SBDC program. It's a nationwide program in all 50 states. It's funded by the U.S. Small Business Administration. Locally, we're part of the UC Merced Regional Network that includes centers from Modesto, Bakersfield, and also Fresno, Monterey Bay, and San Luis Obispo. So we cover actually the counties of Kern, Inyo, and Mono, the Kern County and the Eastern Sierra region. So today, here's a little bit of, if you're going to interact with us, few quick points. Please use your question box. If you notice on the right side, there's a dashboard, and you can open that dashboard up and there's questions, there's chat. If you're having any problem at all, please give us a chat or a question. But also be thinking of questions for our presenters that we'll take later in the presentation. All the attendees are muted, so please type in any suggestions or selections that you might have. At the end, we're going to pop up a survey. So please fill out the survey, as your input and feedback are really important for us continuing. And if you'd like a handout of today's presentation, please mention that on our survey at the end of today. So a little bit about what we do at the SBDC. We provide high quality, no cost, and most importantly at all, to some, confidential one-on-one consulting. And we do that with a wide range of consultants, both young and old, and from student interns to people that are very experienced in their small business. We do training programs. We usually use these webinar series partly because of the vast geographic area that we cover. I see that there are people from Kern, Inyo, and Mono County on today, so it's great to have such a great reach and great visibility throughout those three counties. And we also do special projects and advocate for small businesses and all that fun stuff. The administrator of the U.S. Small Business Administration, Maria Contreras-Sweet, said it best when she said, "The counseling is almost more important than the lending." The SBA is widely known for their lending, but also the resource counselors that are available are a real benefit to a lot of small businesses out there. So today, what we're going to do is we're going to do microlending. And if you were on our webinar last year on the 50 ways to leave your lender, I believe number 33 was going to a microlender. And okay, technically a microlender is still a lender, but it's a unique program and it's not generally bank driven like most of them. So these microlenders will lend as low as, well, it says $25,000, but let's just call it $1,000 just because they feel good today. And some of our local lenders are here with us today. We have representatives from the Fresno CDFI and from Valley EDC, and we'll explain those acronyms in just a second. A couple of other microlenders in our region include Valley Small Business Corporation and RCAC, which does lending in the smaller rural areas. So let's proceed on with our program here today. And our first presenter is going to be Circe Cox. And Circe has consulted in the area of business and finance planning, small business lending, SBA guaranteed loans, and general business for the last 22 years. These days, she's working with businesses in Kern County as a business development officer for a LA nonprofit called Valley Economic Development Corporation. See, we got one of those acronyms out of the way already. Circe has been working with a number of clients in our region on getting them access to capital. And Circe, thank you for joining us. Take it away.
Thank you, Keith. Hello, everyone. I'm going to very briefly talk about what are the 5 C's of lending. I know it's a little bit boring, so bear with me. The first things that we are going to be talking about is, can we go to the lending criteria? The lending criteria is what are the character, the capacity, the capital, the collateral of a business. And what that means is, well, if we're going to look into a business to lend you, just as a bank would, we would be trying to figure out, do you have some of the C's? We don't require all of the C's to lend to a person that comes to a CDFI, but we want to kind of go around that what each one of them means so that you have an idea of when they talk to you about these conditions, you know what they're talking about. So let's start with character. What is character? Character is going to be how do you manage your business? Do you have experience? How long have this industry been around? Is it new? You know, we have a lot of new industries coming into. Does it have a good financial reputation? If you're a very new industry, you may not have a lot of reputation, but you know, we look at the other C's to make sure that you are on target. And then it says accuracy of the application. Well, you don't have to really worry about that too much because CDFI consultants are able to go through the application and make sure that you fill it correctly. The next point is the capacity. What is capacity? Well, capacity is the ability of this borrower, be you, do you have the capacity to pay us this loan that you're asking for? And of course, we will look at your personal expenses, and we're going to look at your business expenses, and then we're going to figure out, do you have enough income to pay this loan? And as you say at the bottom of this this form, it says payment ability is 1-to-1. We like to see at least 1-to-5, but we can manage a 1-to-1 payment ratio. And that's all that it means when they talk to you about, do you have the capacity to pay? Now we're going to talk about capital. And capital is the review of everything that you owe, that you have, that your business will be looking for, like payment history. Have you been a good person paying your debts, be personal or business? Is your debt level too high? If your debt level is too high, then your consideration for the loan may be a little bit more critical. Length of credit. How long have you had credit established? You may not have had any credit established in a long time. Sometimes no credit is better than bad credit. Let's do it. Inquiries. How many inquiries you have? Sometimes people get desperate and they start going to all these banks and credit cards, and they just start getting a lot of inquiries into their credit. And when we look at it, we go, hey, why are you asking 20 people whether they're going to lend you money or not? That makes us a little nervous if you have that many inquiries. And then we look at the mix of your credit, business and personal.
So Circe, on the credit scoring here, this is kind of the mix that goes into the credit score. So payment history, while being the most important, isn't the only determining factor.
No, absolutely not. We have to review all of them. But that's why I'm trying to explain to your audience that it's important for them to understand how we look at credit and how we look at capital. So we'll be able to talk a little bit more about it. Now, the next one is collateral. And yes, we are going to ask for collateral. A lot of the times, people may not have collateral, so we may look at other venues. For example, maybe a spouse is working, or if it's a young child, maybe the parents are willing to put some of their income to help the borrower. But the first thing that collateral means is that if you see the first line, it says UCC1, small business equipment. If you're going to borrow from VEDC and you're going to buy equipment with that money, or you already have equipment, we are going to put it's called a UCC, saying you may not sell this equipment until you pay us. We do take vehicles. They have to be paid, and they have to be less than 10 years old for them to be able to be part of your collateral. And real estate equity, we Look at your home. If your home is, let's say, upside down, we probably will not take it since it doesn't have any equity. However, we're going to look into it and see if your home would qualify for your loan. BEDC requires, and mind you, it changes, but if you have a home and you're asking for more than $25,000, we may require you to put your home as collateral. I said may because it depends on the loan programs. BEDC has 17 different loans, so it depends on where our underwriter decides to put you. That will be based on your collateral or any other paperwork that they may ask for. The next one is conditions. And what conditions mean is how is your industry doing? For example, the conditions for the oil industry right now are changing greatly. You know, the price of oil has been dropping. So that affects anybody that is in the oil industry and anybody that does business with the oil industry. And I'm just saying the oil industry because we're in Kern and everybody understands the oil industry. So we want to know, how are the conditions for your business? What are the conditions for that particular segment in your area where you live? It may not affect it at all, but it may affect somewhat. If you're going to put a bagel store, are there any other bagel stores around? So we also look at those conditions. The following one is, okay, so it says credit, but I want you to know that credit is actually part of character. I have separated the credit slide because I find it very important for people to understand credit. Credit is not our number one priority. However, credit is how they decide what interest rate you are going to get. So, for example, if you have a credit of 750 and up, you're really good. If you have 750 to 749, you're okay. So it goes on and on like that. We do loans for people that have, credit in the 500s because, as I said, we don't just look at your credit score. However, if you have problems with your credit and you have not fixed it, for example, you in 2008 were having a lot of problems, lost your job, and then you couldn't pay your credit cards and your house went they repossessed your home or your car, that would really damage your credit. But if you can prove to us that you have been able to settle your debts, for less than what it was owed, that your house, if you gave your keys away and you did a short sale, we want to make sure that we have documentation saying that that's what happened. So in reality, if you have a bankruptcy, we're okay with bankruptcies if they're older than 2 years old. So let's say if you're going to have, if you think, well, my credit is really bad and I shouldn't go to talk to any of these people, please don't do that. Please come and talk to us because sometimes it's such a simple thing to fix, and then you would be able to continue with the loan request instead of discrediting yourself for a loan. And I think that we're going to learn a little bit more about the CDFIs with our next speaker. So I think I'm going to stop here and let Kelly introduce the other speaker.
Before you do that, you'd mentioned, I'm going to make a little preemptive strike, thinking we might get a few questions because you have 17 loan programs.
Yeah, we do.
And I want to know a little bit about those loan programs, from how small they are to how large they go up to. Some of the characteristics for a few minutes, and then also if we can talk about maybe a couple of successful lenders that you've had right here in Kern County.
Oh, okay. Thank you. We have actually, like I said, we have 17 loans. They're very different loans. They we can lend from $1,000 all the way to $2 million. $2 million would be mostly for businesses that have already been in business for a while. They want to buy maybe property, very big equipment. The 17 different kinds of loans, it's very hard to kind of explain how they are different, because the underwriters are the ones that look at those loans and they place you into the 17 to 16 loans that we have. So we do have the 7A, the 504, the SBA 504, and we have some that are internal lending programs. So it's very hard to explain these programs because they vary so greatly based on the person that's coming to ask for the loan. And so, for example, we have right now here one of my clients who opened his recycling center, and he was not able to get a loan because he was working, but he didn't have a lot of collateral. He had gone to other institutions who had not been able to assist him because he was a startup. And actually, when he came to see me, he didn't even have the space. This is hilarious. So we're going through the process of giving this client his loan. And I said, go show me where your business is going to be. And so he gives me the address, and I drive, and it's a parking lot behind a auto store. And I think, well, where is your business? I don't see anything. All I see is an empty parking lot. He says, oh, it's going to be right here in between this space and this space. And I thought, okay, let me visualize it. And he says, and the reason why I'm asking you for this loan is because I need to get the recycling bin where I'm going to put all the products, and then later on I need to buy the baskets, and I need to buy the scale. And we thought, okay, we can manage that. And so he went through our process, and here he is, being able to get his recycling center going.
Yeah, Dave Smith, the SOS Recycler, started up, and he's been doing great ever since. And out on the corner, I believe, of Callaway and Olive, out in maybe on Jewett, and started up, worked hard, took a lot of effort to get it going, and now he's recycling, has big plans, and it looks like a great success story is coming that way.
Yeah, and one of the things that I got to say is that, Kelly, your program really assisted us with, I didn't want to say the name of the business because I didn't want to offend anyone, but the SBDC has been great assistance with a lot of my businesses that are coming to ask for loans, because you need to prepare when you're coming to see me for a loan, and for any CDFI that you're going to go visit, or even the bank, it doesn't matter. We're going to ask you, what is your idea? Tell us about your idea. Why do you want to go into this business, or why did you go into this business? How much are you asking for? Why are you asking this amount? A lot of the times people come and say, I need money. Well, how much money do you need? Well, whatever you can lend me. No, don't tell me whatever I can lend you. Tell me why you need this money, and why is the amount that you need so important? Because that makes me believe that you really have done your homework and figure how much you needed. So that I think.
Well, great. Well, thank you. Thank you, Circe. Circe's got some great loan program options here in Kern County, from very small to very large, it sounds like. And she mentioned something also, that she has a credit underwriter. And the credit underwriter is important from one standpoint, is that when you meet with Circe or with Jeremy Hofer, who we're about to introduce, they will work with you on trying to get that through their process, but they do not have the final say. There is always somebody farther upstream who gets to decide whether your loan happens or not. So whereas you have great advocates for you in your business, if they're doing the work to present it to the underwriter, not always is their decision the final one. So thanks again. Jeremy Hofer. Jeremy has worked at the Fresno Community Development Financial Institution, CDFI, since 2008. First as a loan officer and now as a business development manager, Jeremy has assisted hundreds of entrepreneurs in attaining access to capital through CDFI's enterprise and microloan programs. Jeremy, thank you for joining us. Welcome.
Thank you, Kelly. And Circe gave a great introduction, because a lot of those, all of those 5 C's definitely apply to any CDFI that's out there, and really any lender that's out there has some mix of components. Even the online lenders look at those, a mix of those 5 C's, and it's really not one of those C's that anybody needs to focus on, and we don't focus on one. It's really a blend of those 5 C's. So thanks for kicking things off, Circe. So I'm going to kind of take a little step back here and get into what the CDFI industry is about, just to give people a background on why CDFIs were established. Back in '94, the U.S. Treasury Department created the CDFI fund, and it has basically provided equity finance or funding for CDFIs like VEDC and like Fresno CDFI. Some of the other ones in the Valley were mentioned already. And the bottom line is that we provide capital to underserved communities. And what that means is if a business is not bankable in some way, whether it's a credit problem in the past or whether it's a cash flow problem or collateral problem, CDFIs are there to bridge that gap. And ultimately, our funding, the amount of money that we have access to, is much smaller than what the banks have access to. So we're really that bridge. We're that primer to bring businesses into banking eventually. And frankly, if they don't need a bank after they're done with us, I should say, and pay us off, that's great, and they can move on. So we definitely see ourselves as a bridge. Here, I'm going to keep moving on, but there's our mission, and it's really creation of jobs and financing small businesses in underserved communities. And I'm going to just pick 2 out of this list to focus on here. Job creation and retention. That's a big thing for us. So whenever you're approaching a CDFI, highlight that. Highlight the fact that you are creating or retaining some jobs out of the project, even if it's something as like a refinance. Describe how that refinance is going to help retain those jobs in your business, because that's our kind of language. That's what we're looking to do. And then moving down the list here, facilitating business to bank relationship. Ultimately, we want to get you in a strong relationship with a bank, and the first question I ask often is have you gone to your bank? What did they say? Where did you leave off with your bank? And so that's kind of our job is to be that bridge. And so this just gives you a little bit of background on what we do. We also go down as small as 1,000, but our top range is only 300,000. So if you are looking for to buy a larger piece of property and you need something like the SBA 504 program, which is great for that, VEDC is a great solution for that. We do our loan programs really are broken down into 2. One is a microloan that goes up to $50,000. And our enterprise loan goes up to $300,000. And I'll talk a little bit about some of the differences there. And as you see, we partner with a number of different agencies that help fund us. Okay, we're going to go to the next slide here. And then some of the things that we finance, working capital. Working capital is often a catch-all term, but really what you want to think about working capital as is that gap between the time that you expense the activity or the service or the product and the time that the money comes in for that product. So cash-based businesses typically don't need working capital. Frankly, working capital is something that is needed when you're running accruals, such as having to make payroll every 2 weeks. Often you'll need some cushion in between that time. Also, if you give terms to your to your clients or your customers. 30-day terms. Well, you're waiting. You have these receivables that you're waiting on. You have to finance them in some way. You've already put out the expense. You've had to pay for the product. So that's what working capital, true working capital, is there. Machinery and equipment. That's pretty self-explanatory. It's commercial real estate. We do both. Like properties up to 300,000, but we also can provide a gap for your bank. So if you've gone to your bank and you found that you have, you need $1 million loan, but the appraisal came in and you're only able to get an $800,000 loan to buy the property, often we can work with your bank and provide a gap in there for that 200,000.
And now that you've seen what Jeremy funds, let's do a quick poll. Here's a poll asking, how much would you like to raise? How much capital would you like to raise? And so please select one of the following: under 25,000, 25 to 100, 100 to 300, 300 to $1 million, really high amounts, over $1 million. So the poll's in process, and so far we're true to our form here with a micro lending webinar, whereas a 40% are under 25 and about 40% are about 100,000 to 300,000 and 30% for the 25 to 100,000. So please complete your process. We have almost 60% of you that have voted, and what we're going to do is give you another couple of minutes, seconds, and close the poll right now. And close the poll, and then there's our results. Wow, it's 22% under 25,000, up to 44% from 100 to 300,000. So thank you for participating, and back to Jeremy.
So just to kind of give an example of one of the projects that we've worked with SBDC on, this was a food truck up in Modesto, actually, that he went and he raised money through Kickstarter. You may have heard of Kickstarter.com. He was able to raise about $20,000 off of Kickstarter, and he did this by getting supporters to pledge $20 for a sandwich once he opened, and I think it was $5 for a high five. But then on the higher level, it was something like $1,000 got you a party, a private. He would cater your private party. So there's a lot of good ideas for how to raise money out there. This was equity money that he brought into the deal, came to us, and we were able to finance the truck for him. One of the things that Circe touched on is in the capital is that there's never a such thing as 100% financing. You need to bring some capital to the table, and that is typically in the form of a down payment. For our startup loans, I have a slide coming up, but on our startup loans, we require 25% of the total deal, the total project, I should say, to be in equity infusion from the applicant. So that means if a project is going to cost $100,000 to get off the ground, you need to bring at least $25,000 of equity. So that's something to remember. There are a number of ways to raise that money other than just cash that you bring, and crowdsourcing is one form that has worked well for a number of our borrowers. So just to kind of step back, minimum requirements in terms of what banks look for. I think you can think of a CDFI as a more flexible bank. We tie our underwriting standards similar to what banks do, but there's a lot more gray area for us, and in that respect, we're able to do deals that banks just are not. So typically, banks are looking for at least 2 years in business with a minimum of 2 years financial statements or tax returns. And I should emphasize, these are profitable tax returns. So if you have 2 years of unprofitable tax returns, it's going to be tough to find bank financing unless you have a very strong collateral source or you're able to get it personally financed, such as through a credit card that's unsecured. There are other manners that you can get through personal finance, but this is referring specifically to business finance. Excellent credit history. I have heard that banks are going lower than 700 these days. Definitely after the crash in 2008, 2009, they tightened up. It may be as low as 680 these days, but credit history. Credit is probably the majority of our clients come our way because there is a blip in their credit history. And, one of the first things we'll ask for is a letter of explanation. Just, give us a little bit of background on what happened there. And collateral. Collateral, except for a line of credit for an existing customer or existing relationship, a bank is going to require pretty strong collateral. Now, banks also have access to the SBA programs that we have, so obviously they would be able to bring in guarantees for SBA. Debt service coverage. This is probably one of the number one reasons I see, another large reason I should say, other than credit, is capacity. Debt service coverage is a very important concept that I believe all business owners should understand. And the simple way to understand debt service coverage is if the ratio is 1.25, that means for every dollar of debt, that includes the future debt that you're applying for, you need to have $1.25 of profits showing. Now that's showing on tax returns, that's showing on financial statements. So that means there's a cushion there, right? So if you have $1 of debt, including the new debt, that $1.25 of profits showing on your financial statements is going to provide a little bit of a cushion. And I'll get into some of what we look for, but that is another area we are more flexible. So we're going to move to the next slide here. We already went through the C's. We talked about the 5 C's, but on this slide, we're really breaking it down to 3 C's here: cash flow, credit, and collateral. But as Circe talked about, there is the other 2 C's include capital and conditions, which are also very important. So we're going to move through these pretty quickly here because we already talked about these. I want to go back to the debt service coverage ratio, though. And for our underwriting, we do require, just as VEDC, a 1-to-1 debt service coverage ratio. That means that for every dollar of debt, you need to at least have $1 of profit available. That's after paying yourself. So that is a much they call it a tighter debt service coverage ratio, but it's also more lenient, and it takes into account that many of the businesses that we serve are cash-based businesses. In terms of credit, here I'm going to just emphasize the cosigner guarantor. Banks will typically not allow a non-participating or like a non-owner of a business to come onto a loan and be a guarantor of that loan in order to help that loan qualify. And that is an area that we are different. We do allow family members to come on board as a guarantor. So if credit does not quite meet the standard, we will ask for a cosigner to come on board to strengthen the request. And I would like to direct everybody to annualcreditreport.com. That is an important site where you can get a free credit report. Everybody should, at a minimum, pull their free credit at least once a year. And so that's one resource. Also on our website at Fresno, CDFI.com, there are tons of credit building resources on our technical assistance page there at the top. I think it's called Business Resources page. So take a look at that. Collateral, I'm just going to focus on, collateral is really the last thing that I think of as a loan officer, because if you have the other C's in place, there are some programs that can come behind and support you. The 2 main programs that we use are the CalCap program and the SBA guarantee, or the 7A program. And so the bottom line is, don't let collateral ever hold you back from making a loan request. It's really the cash flow is going to be the most important, because we need to make sure that there is the ability to repay the debt, and then secondarily the credit is going to be another important area. But like I mentioned, bringing on a cosigner can really help mitigate any issues that you have on those first 2. And then, since I believe that we do have a few startup businesses, or do we want to run another poll?
Sure.
Okay, so I'm gonna go through this. First, startup business. It is a different beast, so to speak, in terms of requesting a loan for a startup. An existing business is, and this is typically why banks will not finance a startup is because an existing business has a stream of revenue that it can point to be able to repay a loan. And so a track record goes a long way in being able to convince a loan officer. In banking, they say the past is prelude. So, they look to the past, we look to the past to basically be able to predict the future. In a startup business, we don't have that luxury, obviously. So what is it going to take? It's going to take a pretty strong business plan. For loans above $25,000, we do require a formal business plan. Loans under $25,000, it can be a more informal type of plan. That includes projections. So you want to do a 12 month by month and a 3 years. And the bottom line on a projection is the first question that we're going to ask you is, what's your break-even point? We want to know that you know that number. And so that's why we have great programs like the Small Business Development Center available to help you find those numbers and convince us that you do know what it's going to take to break even and then move into profitability. As I mentioned, skin in the game is going to be required, 25% minimum. And then bootstrapping and alternative financing. A lot of times on startups, we'll come back and it may not be the number that you requested in the first place. And so, but the bottom line is we will be able to give you a number in a relatively short amount of time in terms of how much we would be able to go with you. And often it's going to may require some additional raising of capital. And so this next slide is, I will go through some of these debt versus equity because it's a very important concept to understand. Debt is used to leverage, equity is used to leverage debt. So there needs to be some type of equity at the table. Debt has scheduled repayments with interest, obviously. We often will do an interest-only period at the beginning of a loan. But on the other hand, equity, there is no repayment schedule. You're not making payments until there's profits available. So, those partners, they're in it for the long haul with you. Whereas a lender like ourselves is really going to, we're going to need our payment regardless of whether there's losses or whether there's profits. Lenders like us and VEDC, we typically are more flexible. So if there are workouts that are required along the course of your business rollout, that's something that we would readily do with you. But equity finance is much more patient. It's not going to demand repayment until those profits are realized. So having a good balance between debt and equity is really one of the keys to success. And then alternative financing options. So, in addition to a microlender like ourselves and VEDC, there are other types, hard money loans and factoring, which both are typically very high, including credit card in terms of interest, high interest rates. What you want to, especially in terms of online lending, is you want to know upfront what's the APR. Don't just focus on what the interest rate is. One of the oldest tricks in the book is that lenders will offer a very low interest rate, yet charge you all kinds of fees, which ends up especially on a short-term loan, it's going to end up costing you a lot more than if you had taken that little higher interest rate with a bank, but something that's not going to be chock full of fees. Other types of equity, how to raise that equity. We've seen people pull from retirement. There are some for starting businesses. There are some ways for tax savings on pulling from retirement, although we don't encourage that. We'd prefer you come to us first before you pull from retirement. Friends and family, obviously. Pre-sales, it's a great manner. And then crowdfunding, as I mentioned. So I'll end it here. Here's a couple of other alternative financing options. I'm going to pass the mic to Circe, and she's going to follow up with some of the points that we've made.
Thank you, Jeremy. One of the things that I need you to, please, thank you. One of the things that I want to point out is that CDFIs like the Fresno CDFI and VEDC, we do not have any other banking services. We do loans only. But my understanding is that do you provide any lines of credit or not at all? So no lines of credit on any of the CDFIs. This is very important for you because you need to understand that if you come to us, we are not going to be able to provide you a line of credit. It's strict lending only. We work very closely with banks. banks are our best friends. And the reason why banks are our best friends, as Jeremy was explaining the federal law with the CDFIs and how we get money, another little part of that history is that the banks are required by the federal government to lend money to the CDFIs to then lend money to you, because you would not qualify through their banks. And so the money that the CDFIs have are not grants from the government. These are money that we have to repay the banks because they're lending us the money to lend them to you. We have a very more flexible criteria on how we can approve a loan. So like I said, we have a little bit more leeway. However, we are regulated very closely like the banks do. And so you have to be, I caution you, if you're going to be going to people on the internet, lenders on the internet, that you know who they are. You want to be able to communicate with them. There's a lot of situations where, for example, I have a client right now who's a restaurant owner, and we did a loan with them, and he cannot get a hold of our underwriters. He has all these questions for them. So he comes and talks to me and says, seriously, I cannot reach this person at your office. Would you please do that for me? And so because I have a relationship with our underwriters, I can get information for them easier than if you go to somebody on the internet and you have no idea who you're dealing with. So it's just a word of caution. I'm not saying for you not to do it. I'm just saying please be careful on those situations.
Yeah, I mean, just to piggyback on that, we're seeing a lot of people coming to us with these online loans, and they're caught in a debt spiral because of them. I mean, quite frankly, it's quick money, so it is. I mean, it takes 2-3 days, pretty quick approval. But the repayment schedule is so aggressive because they are trying to, basically they're funded by investors who want their money back within 2-3 years. And so that aggressive payment schedule is often can sink a growing business because they need that patient capital to stay with, and they need to hold on to that principal longer. So that's why BDC and our loans of 4 to 6 to 7, even 10 years can provide that patient capital and so we're doing a lot of refinances of these online lenders.
One of the best uses we've seen out of online lending is for people to just have the deal of a lifetime. You have a deal that has to be done in 3 or 4 days, and you're getting an incredible bargain, and nobody else is going to be able to turn that quicker. So the online lender's niche, in our perspective at the SBDC, is for that deal that has to be done in 5 days.
Mm-hmm. Yeah.
So that's something to keep in mind when looking at online lenders also.
And if you do get those kind of loans, because, for example, I did have a business, I don't want to mention their name because we didn't ask permission to do that while we were on this show. But I have a business that they were going to foreclose on their business because she could not pay the second, and she was horrified that this situation was going to happen. And she came to me and said, I only have this short time to get this money, or they're going to take my business property. And I thought, oh my God, we could not get you this money fast enough. She said, well, there's this other lender that will lend me the money really fast, but they want the money every day. They're going to take money out of my account because she takes credit cards. So they were removing money from the credit card vendors. And so I said to her, well, here's the option that I can offer you. Take that lender because you're desperate and you needed to have had this money 15 days ago, and now you don't have it. And then we'll be able to then, once you are done with it and everything's settled, you're not going to lose your property. We can then refinance that debt for you, pay that guy that's charging you so much money, and then put you on a regular loan program. And that's exactly what we had to do with this client because her situation was dire. So there are times where you may have to go to this kind of lenders that are so, can I use the word shark lenders? They're a little bit more aggressive. towards getting their money back. But there's ways that I'm sure that the Fresno CDFI and VEDC are able to then provide you assistance. And then once you're bankable, because this is a business that came through me through a bank, and in 2 years, we're going to go back to the banker and say, let's review this client and see if we can put them back in the bank, which lowers their interest rate some more.
Great. Jeremy, do you have another example or two of a lender? I know we showed earlier the food fix truck. Do you have another lender that you can give an example of any challenges that you faced or any particular circumstances that helped that deal go? And then we'll get to some questions.
Well, another issue that can arise with like particularly acquisitions and startups is time in the industry. So banks, it may be the application may be bankable, except that there isn't a minimum, a specific amount of time in the industry. And so we do pick up less experienced entrepreneurs. So somebody that's like acquiring for example, we had a bakery acquisition that took place in the North Valley. It was an old Portuguese couple that had built this business over 40 years, and an Iranian immigrant family wanted to take it over. Now, the person that was applying was the daughter in the family, and she had book savvy. She had done books for her dad's business, who was a trucking business, and she was kind of the person that was going to be able to manage the business. However, she had never baked a loaf of bread in her life. However, what I knew was her brother, who wasn't on the loan, but her brother had a passion for baking, and he had baked for 3-4 years at another local bakery. So that was something that the banks were not going to do. They referred him to me, though, because there was a lot of merit to the request, and we were able to help them out with about $35,000 and get them that business acquired. It did go through escrow. It was a bulk sale. And so that's another example. Another, just a quick one, was a softball academy where the woman who ran the academy wanted to build a kind of a facility at her home so she could be closer to her kids that were being babysat during the day. And they had just bought a ranch. And, a bank would not have helped her build it because it was just such a slim second that they would have to take on the home. And again, here's the collateral issue. Banks are going to go up to a certain loan to value on that property. And we were able to do the deal with some help from the CalCap, the CalCap program, which is the California Capital Access Program. And so we helped her build out her softball facility, and now she's much closer to home, and quality of life is much better, and her business is growing again. So, I mean, there's just a lot of stories that Circe and I can tell about these, about different deals. But bottom line is, if it's not a bank-ready deal, it's probably something that we can entertain.
Here's a couple of specific type questions. I'm married. Is my spouse required to be on the loan documents?
For VEDC, your husband would have to sign saying that he understands that his salary would be used as part of the collateral that would be placed on this request. So yes, your husband doesn't have to be on the loan paperwork. However, your husband does have to sign a letter stating that he understands that you're starting a business, and that, yes, his salary is going to support you financially while you're in that business.
Yeah, and so for CDFI, that may be a little difference there. If it requires the husband's if the husband's salary is required, we do need this husband to co-sign and guarantee the loan, and otherwise we cannot include the husband's salary or the wife's salary on the loan. And so that is a question I often get. But, a lot of times our response is, look, we're in a community property state. And so basically any debt that you do take on, your husband is taking on as well. And so that is something that often, that you should prepare for, especially in a startup situation. Now, if you're an existing business and the business itself is able to show that it can service the debt and doesn't require an outside salary to kind of come in and support that, then no. The answer would be no. We typically do not require any spouses on existing businesses.
Okay, what if the industry is so new that you are the only vendor in that particular industry?
Well,
Sounds like an ideal situation if there's sales and to be generated from it.
that would be something that we would have to look very carefully. We would have to look at all the other C's. And if this industry is so new, we would have to see what is the potential for this business.
Yeah, and this is again where the SBDC can really play a role in advocating for you. As a business development officer or a loan officer, we don't always have the time to vet a new industry. We don't have the depth of knowledge that you bring. But going into consulting with an SBDC advisor and essentially in a way convincing them or having them help you put together that plan that demonstrates. For us, we'd want to know, okay, well, where's the revenue going to come from? Who are your customers? What are some assumptions you're making in terms of that projection? It all boils down to that projection, really, because that projection is what's going to show that you're going to be able to repay this loan. So yeah, get to your SBDC advisor and have them help you put together a good business plan that demonstrates those conditions.
We have a question. Do you have an office in Bakersfield, or do you have any Spanish-speaking staff? And since seriously we didn't have your contact information up, why don't you give your contact information right now? And because Circe definitely speaks Spanish, I've heard it, and she speaks it very fluently. So she would be the perfect person to talk to right here.
Yeah, hi. Well, my phone number would be 661-817-8048. Yes, we do have an office here in Bakersfield, so call me and I can give you the address. And my email is ccox@vedc.org. And again, my phone number is 661-817-8048.
Well, that about wraps it up for today. Thank you for joining us, and I'd like to thank our guests, Circe Cox and Jeremy Hofer. And if you do need a loan, contact them or contact the SBDC. If it's outside of the realm of what we talked about, contact us or contact them. Our next webinar is coming up in 2 weeks on February the 24th. It's going to be on energy efficiency programs in small businesses. And there's a lot of incentives. There's grants and loans and some very unique programs. And we'll have our presenters, Keith Bryce of Midstate Development Corporation and Megan Porter of PG&E. So for Circe Cox and Jeremy Hofer, I'm Kelly Bearden. Please complete the survey at the end of today's webinar. We'd like to get your input. If you'd like the slides or anything, they'd be available there. Thanks for joining us, and we'll see you next time. Goodbye now.